Good afternoon. Welcome back to Passionate World Talk Radio Network, a wholly owned subsidiary of Global Media Network, LLC. Educate, enlighten, entertain. And on to this episode, we are going to talk about the economy. Silly. The economy just did this for only the 13th time in the past 85 years. History shows us usually leads to a bear market. The labor market activity has historically been strong recession indicator. It flashed one of the greatest and biggest red flags in years. This article was written by David Durkin on March 11th, 2026. And he says the key points to keep in mind are monthly non-farm payroll growth has historically been highly correlated with broader economic trends. The February 2026 report was the fifth negative one in the past 9 months. Historically, that has occurred with almost at every recession in the past 80 plus years. 3, year-over-year non-farm payment growth is close to turning negative, which has happened with every past recession. So, the February non-farm payroll report came in way below expectations. The economy lost 92,000 jobs, although the overall unemployment rate remains at a low 4.4%. Just as importantly, the January number was revised lower by 4,000 jobs, and December's was revised down by a whooping 65,000 jobs. Now, a lot of these jobs could be connected indirectly or directly to artificial intelligence, where companies are just laying off vast amounts of their employees because AI can now do their jobs just as effectively, if not better. So during the last 12 months, that has brought the total numbers of jobs to 156,000. And to put that into content, the economy was frequently recreating that many jobs in 1 month as recently as 2023. So let's take a look at what they're saying. Stagnant job growth is one of the biggest red flags in the economy. It suggests that perhaps companies don't see growth ahead that warrants increasing headcount. Companies could also be cutting costs to manage a particularly lean period. And whatever the reason is, it's a fairly strong indication that growth is slowing, or companies think it is slowed. That, of course, spills down, yes, to us consumers. If workers lose their jobs or believe that they're at risk of losing their jobs, they tend to cut back on spending, which supports our economy. Less income and spending translate to slower economic growth, higher default rates on debt, and a number of other consequences. And unfortunately, we've been seeing this same pattern now over the past 12 months, which is rare, and it's not good. Non-farm payroll growth has been negative in 5 of the previous 9 months, since the Bureau of Labor Statistics began releasing this report back in 1939. This 5 in 9 stretch has happened only 13 times. And when it happens, it tends to correlate with recession and bear market corrections, at least 20% in the S&P 500. So if you want some evidence to back all this up, to back up this trend and why it's so worrisome, consider the times it happened before 2026. 2008 to 2010, 2001 to 2003, 1990 to 1991, 1982 to 1983, 1975, 1970, 1960 to 61, 1957 to 58, 1954, 1952, 1949, and 1944 to 1945. Now, we can overlay the non-farm payroll data with historical recessions. Almost every one of these 5 and 9 period coincides with recession. And it should be fairly obvious. Slowdowns in the labor market are almost always part of a broader economic slowdowns. What's interesting is in 2026 is thus far there's been little sign of imminent recession from the major indicators. According to FactSet Research Systems, the estimated year-over-year earnings growth rate for the first quarter of 2026 is 11.5%. If that turns out to be the final number, it would mark the 11th consecutive quarter of year-over-year earnings growth and the 6th consecutive quarter of double-digit growth. U.S. gross domestic product, or the GDP, grows at an annualized of 1.4% in the fourth quarter of 2025. That marks the 14th time in the 15 quarters that the GDP growth has been positive. With those growth rates, it's tougher to make the recession argument. The massive investments being made in artificial intelligence might be masking some underlying weakness, but earnings growth in GDP growth are major reasons that U.S. equity prices have held up so well to this point. Overall, though, we shouldn't ignore what the job market is telling us. There is one final way of looking at the situation. Every year-over-year non-farm payroll has turned negative, has been tied to a recession. We're not there yet in 2026, but the growth is negative over the past 10 months. And the biggest monthly gains are about to roll off the 12-month rolling average. So it's quite possible, folks, maybe even likely, folks, that we'll get there once the April report is released. Either way, this is a strong historical recessionary signal. Savvy investors would be wise not to ignore it. So, before you buy any shares in the S&P 500 index right now, consider this. The Motley Food Stock Advisor analyst team just identified what they believe are the 10 best stocks for investors to buy. So please go over to passionatedworldtalkradio.com/blog. Listen to today's episode, read the summary, and then by all means click on the URL that's provided to you and find out what they recommend and read the rest of the story. Thank you very much for joining us this afternoon. Have an awesome, if somewhat wet and cool weekend. Thanks very much. And be on the lookout for PWTRN's Daily Bread. It's a slice-by-slice newsletter. Started this past Sunday. Check it out. It's on the website, passionatedworldtalkradio.com. Once again, if you want to hear and keep on hearing all this mesmerizing information without the you-knows, does, we haven't the slightest idea, don't listen to it, Chicken Little, the sky is falling, please consider supporting us. passionatedworldtalkradio.com/donations. We would appreciate $5 if you can afford it. Thank you very much. Have a great day.